Good evening. We're going to discuss regarding venture capital. We are guiding partners of BIM, Oman Group number 2. Venture capital is a form of private equity financing provided to early stage and high potential and high risk company with a potential for rapid growth and significant returns. Venture capital firm or investors typically provide funding to a startup or early stage company that have a strong business idea, a scalable business model, and promising market potential. In return of their investment, venture capitalists typically receive a equity in the company, which means that they own a share of business. They may also require a seat on the board of directors and play an active role in the company's strategy decision. Venture capital is a high risk, high reward form of investment. Not all startup or early stage companies will succeed. And venture capitalists expect that a significant portion of their investment will fail. However, the potential for a few successful investments with high return can make up for losses. Venture capital plays an important role in funding innovative and high potential business that may not have access to traditional form of financing. Let's see the key features of venture capital. Short-term investment, approximately 5 to 7 years. High risk and high growth potential. Capital investor for equity stake. Involved in the portfolio's company management, strategic and planning decision by appointing an expert general partners of the VC as a board of directors for portfolio. Let's see the history of the venture capital. George Dorian, who was moved to US from the France to get a business degree, started the first self-proclaimed venture capital firm, the American Research and Development Corporation, called ARD in 1946. If you see evaluation of venture capital business in 1970s, venture capital emerged as an asset class to finance new industry after US recession. In 1970, regulation made it possible for a pension fund to directly invest in venture capital fund. This further improved after reducing the tax on capital gain and profit margin. Venture capitalism became innovation to drive in the west coast of US, and the concept soon became popular among the rest. I'll hand over to Ganga to continue this one.
Thank you, Mahfaz. Let's discuss on venture capital financing methods and current trends. Classification of venture capital is done based on its application at various stages of a business. First, seed funding. This is the earliest stage which provides capital to develop a new business idea and launch a business. Funds are provided by venture capitalists to new business ideas with a huge potential to grow, expecting a sizable gain. Early stage financing aids new firms with funding requirements in product development or launching of a new product to the market. Expansion funding used by companies to expand their businesses into new markets or to acquire new assets, often used to fund product development and new marketing tools. Mezzanine finance, this is a form of debt financing that is used to fund late stage companies that are close to going public. Bridge financing, used to provide short-term capital to a company that needs immediate funds, often used to bridge the gap between funding rounds or to finance a major acquisition. Strategic financing provided by corporate investors interested in the long-term potential of a company. Who can avail venture capital? It is the most suitable option for funding a costly capital source for companies, mostly for businesses with large upfront capital requirements, which has no other affordable alternatives. This is the reason why venture capital funding is most widespread in the fast-growing technology and biotechnology fields. Early startups, entrepreneurs seeking funding for startups often approach venture capitalists to finance their ventures. VCs invest in the startup companies with a promising business model and high potential for significant returns on investment, expecting a sizable gain. Emerging companies. VC financing allows emerging companies to access capital that might not be available through traditional sources such as bank loans or public markets. Troubled companies. Providing venture capital to troubled companies is typically riskier than investing in established high-growth startups. Most common approach is through distressed debt investing, where investors purchase the debt of a struggled company at a discount with the hope of eventually restructuring the company and selling it for a profit. The current trends. The war in Ukraine, high inflation rates, rising energy prices, looming threat of global recession created a storm of challenges within the global VC market. As per KPMG Global Report in Q4 of 2022, VC investments dropped globally. VC investment in both the America and Asia dropped for the fourth straight quarter in Q4, while Europe experienced a drop from third quarter. Late-stage VC investments saw the sharpest drop in falling valuations and concerns about profitability and sustainability of business models given worsening global economic conditions. Venture capitalists of pre-COVID area focus more on the business entity than the sector. Post-COVID, focus has shifted towards energy and healthcare. China's Gakkeon securing a USD 2.6 billion is a good example for it. Now over to Ramana.
Thank you, Ganga. Venture capital financing decision-making process. The first step is in the process is sourcing potential investment opportunities. This can involve networking, attending industry events, reviewing business plans and pitch decks, and other methods of identifying promising startups and entrepreneurs. Once potential investment opportunities have been identified, the next step is screening them to determine whether they met the firm's investment criteria. This can involve assessing factors such as the market opportunity, the quality of the management team, the competitive landscape, and the financial projections. Next step is conducting due diligence. This involves a detailed analysis of the company's business model, financials, market opportunity, management team, legal and regulatory compliance, and other factors as well. Then the venture capital firm will begin negotiating the terms of the investment with the company's management team. This can include discussions around the amount of funding, the valuation of the company, the terms of the investment, and other key factors as well. So the final step is the investment itself. This can involve the transfer of funds to the company, the issuance of shares, other securities, and the implementation of the terms of the investment agreement. So talking about the success stories globally, we can take Airbnb, founded in 2008, which is an online marketplace helping renting out properties. So Airbnb has received $7.2 million, which they have accumulated into 6 billion, and now the market share is 30 billion. So same as Airbnb, Uber has raised 1.25 million from Round Capital and Lawrence Capital. Dropbox has received 1.2 million from Sequoia Capital. And just as like that, Slack, Facebook, Warby Parker, and SpaceX has requested for venture capital financing in their initial stages. So talking in Sri Lankan context, PickMe, as you know, is a Sri Lankan ride-hailing app and has received a significant venture capital financing in 2017, like $5 million US. And same as PickMe, Ikman.lk, Pay Here, 99X, Direct Pay, has received venture capital financing in the initial stages, and they have made it a success story. So to continue, I'll be handing over to Angela.
Thank you, Ramanam. Venture failures, capital failures. I will be discussing 4 companies which have faced the venture capital failures, which are Essential, Terence, Nastigal, and Jawbones. Essential was founded in 2015 and it's a venture company investment of $330 million. Terence founded in 2003, venture investment $700 million. Nastigal founded in 2006, venture investment $49 million. Jawbone founded in 1998, venture capital of $900 million. The National Venture Capital Association of the US estimates that 25% to 30% of venture-backed businesses fail. 2012 research by Dr. Shikhar Ghosh puts the failure rate at 75%. Essential Products in America Technology Company, founded in 2015 by A. Rubin, creator of the Android operating system. The company developed, manufactured, and sold essential phone and accessories for it. It was backed by Red Point Ventures, Playground Global, and had a total disclosed funding of $330 million. Initially, the company fared well and valued at $1 billion, but the startup struggled with the sales and development of a new device, and investor lost its interest. In February 2020, the company announced that it was chasing the operations. Nasty Girl is an American retailer that specializes in fashion for young women, founded by Sofia Amoroso in 2006 as an eBay store. By 2011, it was $23 million revenue and received venture capital investment of $49 million from Index Ventures in 2012. The company grew to $100 million revenue by 2012. Due to lack of top-line growth or profitability, the company couldn't secure more capital or a buyer. Filed for bank bankruptcy in 2016 and was eventually bought by Boho Group in UK. Handing over to Chamara.
Thank you, Angela. Let's continue with our opinion on venture capital. So it can be a crucial source of funding. Unlike traditional lenders, they are often more flexible, that they may not require collateral guarantee, and they may also open for negotiation. They play an important role in driving innovation and economic growth to strive for a more inclusive and equitable funding landscape. Venture capital firms often bring not only financial resources. Venture capital firms often have a team of experienced investors who can provide valuable guidance and advice to startups. They often have an extensive network of contacts which can help startups connect with potential customers and partners. They are typically focused on long-term success of the companies that they invest in. However, venture capital investments also come with risks and challenges. Venture capitals typically invest in exchange for equity, which result in equity dilution over time. Entrepreneurs may need to cede some control over key business decisions to their investors, leading to conflicts over the direction of the company. Preference for high-growth companies can create pressure for startups, rapid growth and profitability, which may not be feasible for all businesses. Criteria for investment can be quite strict. Quick exit strategy to realize their return on investment can lead to pressure to go public sooner than the founders may prefer. Venture capital funding can exacerbate inequity in the startup ecosystem, as certain founders and companies may have more access to capital and resources than the others. So how to use venture capital wisely? A clear plan is needed before accepting venture capital, including milestones, metrics that will allow you to measure progress and success. Typically used to fund rapid growth. So focus on scaling your business, such as expanding your product line or entering new markets. It is easy to get carried away with the spending when you have a lot of capital. So need to be strategic, avoiding unnecessary expenses. Investors' experience in industry can provide more than just funding, with strategic advice and connections. Keep investors informed about your progress and challenges to build trust and ensure goals. Be prepared for a long-term commitment. It is easy to get distracted by new opportunities or ideas, so stay focused on your core businesses. So in conclusion, this is a form of temporary equity or quasi-equity investment in a growth-oriented business managed by highly motivated entrepreneur. High risk, high growth potential investment, funding at different stages of your business. Despite this, venture capital remains an attractive option for many businesses, particularly in the technology and biotechnology fields. And the trend towards startups and energy, health sectors is expected to continue. Thank you. And our group members include Mafaz Mansoor, Ganga Ranavira, Ramano Henriquez, Angela Vikramatna, and Chamara, myself. Thank you very much.